We obsess over stock pickers, we analyze day traders. But there's this investor nobody talks about, the one who went passive and then quietly didn't, chose ETFs, thought it was the same thing, traded more anyway. And it all traces back to one design decision that rewired their patience completely. Picture this. It's 1999. You're 28. You've just read your first John Bogle book, and you feel genuinely smart about money for once. You open a Vanguard account, buy a total market index fund, set up automatic contributions, then you do what Bogle told you, nothing. The price updates once at day's end. You can't be impatient. The system won't let you be. Patience feels easy when it's not. Optional. Now flash forward to 2010. Same person, slightly more online, slightly more confident. A friend mentions ETFs. Same holdings, same low fees, but you can trade them anytime markets are open, like a stock. Same asset, different wrapper. You buy SPY, something shifts. You start checking the price at 11 a.m., then 2 p.m. You tell yourself you're just watching. But watching and waiting aren't the same thing. By 2012, you've traded in and out 4 times. You called it rebalancing. It wasn't. The moment you could act, you did. And that's the psychological trap hiding inside the ETF. Here's the first weird thing about ETF investors. They chose the passive vehicle, they said long-term. They read all the same books as the index fund crowd. Same Bogle, same Buffett quotes, same understanding that timing the market is a fool's errand. Then they traded more than almost anyone. A Vanguard behavioral research study found ETF investors turned over their portfolios at a rate roughly 6 times higher than traditional mutual fund index investors holding equivalent positions. 6 times, not 60% more, 6 times. Here's your coworker Jake. Bought VTI in January 2020, called himself a long-term investor. Sold in March when everything dropped. Bought back in June after markets recovered. Paid taxes on gains he hadn't actually kept. Lost the bottom and the recovery in a single panicked afternoon. Jake didn't fail because of the market. Jake failed because something about the account invited him to react. It's not recklessness. It's access dressed up as empowerment. Here's something that confuses people when they first look at ETF expense ratios. ETFs are genuinely cheaper on paper. The Vanguard S&P 500 ETF, VOO, carries a 0.03% expense ratio. Its equivalent mutual fund index costs slightly more. The math is clear. ETFs win, but expense ratios aren't the only cost. Morningstar's 2023 Mind the Gap study found ETF investors surrendered an average of 1.7% annually to behavior gaps. The difference between what the fund returned and what the investor actually captured. The fund returned 12%. The investor kept 10.3%. The 1.7% gap wasn't from fees. It was from decisions. Bought high after reading a headline. Trimmed when things got choppy. Missed the recovery weeks. Someone in Omaha once said the stock market is a device for transferring money from the impatient to the patient. He was describing ETF holders specifically. He just hadn't met them yet. Lower fees on paper don't survive. Higher anxiety in practice. Let's talk about what people actually buy. When they say they're buying ETFs, they say broad market, low cost, diversified passive. They buy AI ETF, clean energy ETF, blockchain ETF, obesity drug ETF, the one their brother-in-law mentioned at dinner. BlackRock's 2023 global ETF flow data showed thematic ETFs attracted $45 billion in inflows during a period when their average 3-year return was negative 19%. Negative 19%. With $45 billion flowing in. The money arrived after the story got loud. The returns happened before anyone was watching. Remember, 2021. Your neighbor buys ARKK, says it's diversified. It held 35 stocks, but half sat in one sector. Cathie Wood appeared on every podcast. Her name became a verb. The fund peaked in February 2021. Retail inflows peaked 3 weeks later. By early 2023, it had fallen 75%. That's not diversification. That's concentration. Wearing an ETF's badge. Theme buying feels like research. It's pattern matching in expensive clothing. Here's a stat that surprises behavioral finance researchers the first time they run it. The holdings inside an ETF and a comparable index mutual fund can be literally identical. Same stocks, same weights, same rebalancing schedule. One investment, two different wrappers, but the investors behave completely differently. A 2019 study published in the Journal of Financial Economics found that access to intraday pricing increased retail trading frequency by 37%, with no corresponding improvement in returns. 37% more trades, 0% more returns. Index fund investors, same market, check prices roughly twice a month. ETF investors, tracked in the same study, checked 11 times. Not because they were more anxious people, because the interface kept showing them a live number that changed. Seeing movement creates the feeling that something needs to be done. Nothing needed to be done, but the number moved. Visibility creates the illusion of control. Control creates the urge to exercise it. But here's the twist, the one area where ETFs genuinely, structurally win: taxes. And it's not close. ETFs use something called in-kind redemptions that prevent the fund from generating taxable capital gains distributions. Index mutual funds can't do this as efficiently. In a taxable brokerage account, holding an ETF is objectively smarter from a tax perspective. Morningstar's 2023 tax cost ratio analysis found ETFs distributed taxable capital gains to shareholders 80% less frequently than comparable mutual fund index products over the prior decade. 80% less often, worth thousands over a long horizon. But here's the catch. Dalbar's 2023 quantitative analysis of investor behavior found the average ETF investor holds their position for just 3.2 years before selling or switching. Tax efficiency is a compounding advantage. It only works over decades. The average ETF investor doesn't stay long enough to collect it. It's a long game feature operated by short game players. Here's something that confuses newer investors when you explain it to them. The best performing investment accounts in history weren't managed by the most sophisticated investors. Fidelity's internal performance data, surfaced in a widely cited 2022 analysis, found that accounts with 0 logins, investors who had forgotten they had the account entirely, outperformed active account checkers by 1.5% annually over a 10-year period. 1.5% per year from doing literally nothing. The highest performing accounts were held by people who were deceased or had simply forgotten to log in. This is the paradox at the center of the ETF. It's a product that rewards the investor who treats it like an index fund. Buy it, ignore it, let it compound. But its design actively makes that behavior harder. It gives you a live price, a trade button, an app that loads in 2 seconds. Passive investing is a behavior, not a product. The product is just where the behavior starts. The thread through all 6 beats is the same. ETF investors aren't reckless. They saw better fees, flexibility, tax treatment, and picked accordingly. Right call on paper. Drop a comment. When did you last check your portfolio? And did you actually do anything after? That gap is your behavioral cost. Subscribe if you want to understand the psychology behind every money decision you think you're making rationally.